Hello and welcome back to the ROI channel, ROI monthly exclusive content. I'm so excited, guys. Today, we're going to be talking about an investment that I am continuing to scale into. It's an investment that is one of my highest conviction plays at the moment. And I'm going to share with you my opinion, my thoughts on this particular investment thesis. And I guess we're going to see how it all plays out. It is stock analysis today, my take on BW Energy. Without further ado, let's get into it. Before we do, sponsors message. So if you are interested in upping your trading game, if you want to learn of a way that I use as part of my fund that's carved out specifically for generating weekly and monthly income using options, mainly selling options, then become an options maverick today. The link will be in the description. This is a fund that I have run where you can learn from my battle tested options trading strategies. It allows me to generate income from selling insurance essentially over stocks, and I can do it anywhere in the world with my iPhone or laptop. Returns so far, last year were over 20%, albeit it wasn't a full year. So far, we have a year-to-date 36% return. All of these trades are available inside the group. You can see every single thing that I have done with this publication. We've been able to generate over $500 per week in weekly income, working out at around about a 1% weekly target return. So with a capital stack of 50,000, but you can scale it up or down depending on your capital stack. Got global accessibility, exclusive insights, and trade alerts. I tell you every week the exact trades that I'm looking to do, generate for this particular fund's strategy. We've got a great community, and it allows me to live a certain lifestyle, which obviously if you've been following me on Twitter, if you've been following me even on Instagram or whatnot, you've been able to see over the last year or so, whatever the case may be. So start your journey today, unleash the power of options trading and fund a lifestyle being an options maverick. Link is in the description, and you get a 7-day free trial. So that's that. Obviously, trading involves risk, so please view this with caution. Make sure you do your own due diligence before making any investment decisions. I cannot guarantee performance results. I cannot guarantee the accuracy, all that sort of stuff. Disclaimer, guys, you're on your own there. And a disclaimer for today's presentation, all the presentations on the publication, this is just my opinion. It is not intended, nor does it constitute financial advice. You need to seek your own qualified financial advisor, and that is not me. This is just my opinion, sharing it with the world. So with all that out of the way, let's dive straight into the investment thesis in a nutshell for this particular company. You guys will know, having followed the channel, that I'm extremely bullish on offshore. If you haven't seen my conversation with Trader Ferg, you can check that out on the channel where we do more of a macro summary in terms of offshore. But BW Energy is an explorer and developer producing oil and natural gas fields, mainly offshore. So they've got West Africa, Brazil, and a big one now in Gabon. Company's founded in 2016, has been very well run by some Scandinavian lads. Their experience in the sector, management, they have a huge insider ownership, and management has treated shareholders extremely well. I'm so interested in the thesis because of their ability to self-fund expanding production at good IRRs. They've done a very good job of this so far. So they've got the track record on the board. And I believe that currently, towards the end of the year, we will see management guiding almost a tripling of their production capacity of their lifting barrels by the end of the year. They have said that once they get 2 of their sites into full production, that they will pay out 50% of the profit as dividends or shareholder returns once that occurs. So very, very, very interesting, considering that management are guiding by the end of the year, they can triple production. So let's take a look. This has been taken straight from the company's website. This is what they're doing. They're maximizing long-term value by improving their assets. They're progressing towards discovered resources at very conservative estimates of reserve value. And I'll give a back of the napkin estimate as to what I think that might look like. They've got a very short development cycle. They're very good at getting what they need to do done, and taking an exploration development project into production. Operating future cash flow is what's funding their development. So they really don't have much in the way of debt concerns, which is very, very good. adding new resources through low per barrel acquisitions. We can talk about that. Active exploration around existing infrastructure, and that's going to be key in an inflationary environment. And of course, the big one, returning value to shareholders through dividend and share price appreciation. So they're listed on the Norwegian bourse, which is a little bit different. So here are the Norwegian numbers, and I've given a reference to the US dollar chart here. And then as we go into the next chart, you'll see everything translated into the US dollar. I don't know what to say. Trading at roughly 1x book of last year's book value that's since increased. It just, to me, it looks like a really, really interesting play. I think this is one of those opportunities where you get ahead of the crowd, and I'll probably be a little bit early, but yeah, if you look at these growth numbers for the revenue, the EBITDA, and the earnings CAGRs over the next 2 years, I mean, it looks as if all the analysts are giving the management guidance a lot of credit. This, in my opinion, is the most important chart for the company's quarterly report. So it's been taken from that presentation. Here's what they've been doing quarter by quarter from 2021 in terms of barrels per day production. So by the end of this year, we're currently at 16th of July, as I'm recording this. As Golfinho comes into production, that is essentially going to more than double their production, close to tripling their production is what they're expecting. So going from circa just 14,000 or less to almost 34,000 barrels a day lifted is an enormous increase in production. And I think that a lot of people are asleep to that at the moment. So I put out a question to Twitter recently, you may have seen, asking people what sort of valuation multiples they're looking at, all these people looking at offshores or any energy investments. If we look back, it's a short time frame, but it's relevant because it takes into account COVID and the new kind of like ESG views towards valuing these businesses. If we look at the mean here from price to book, 1x to 2x is certainly not unreasonable at all. And if we look at PE, a 16 is the mean, and an EV to EBITDA of 4 is obviously extremely low. So I'm using similar type calculations when I go to do the back of the envelope vals. So as it stands, if I look out past the end of this year into 2024, I'm using analyst numbers. These are not my numbers. I think these are conservative numbers. In any case, let's take a look. So book value estimated around 4.63 at the end of 2024. It's a little over $3, I believe, right now. So you're getting it at a discount to book. I think that by the time this cycle is said and done, I think twice book value will probably be the peak for the cycle. But if we're conservative and we use a 1.5x book value, the implied price is $7. So obviously that's a steep increase from where we are now. If you break down EBITDA on a per share basis, and we use an EV to EBITDA of 4, which again is very conservative, I could easily imagine this at 8 to 10, maybe even 12 times EBITDA. 10 times EBITDA yield in the middle of a bull cycle is nothing unheard of. But in any case, sticking with this 4 times EV to EBITDA valuation, we're suggesting a PT of around about 12.62 in the end of 2024. And if we do a similar things with earnings, just using a very conservative 8 times multiple, we're looking at 13.2. In previous bear markets, if you adjust for interest rates and inflation, if you're looking at a broad sector S&P valuation of around about 10 to 12, it's certainly not unreasonable to use an 8 PE multiple for something I think is going to be in a growth sector, in my opinion. So we may have on a very rough back of the envelope calculation, looking at a 4-bagger in terms of its potential valuation moving forwards. Now, I don't know if the stock's going to re-rate quite like that, or whether they're going to just continue to pump out double-digit dividend yields. I don't care. Okay, I really just don't care if it's going to have a shareholder return program of 50% payout ratio one way or the other via buybacks, which would re-rate the stock, or via dividends. As long as I get my money, I'm happy. So if we take a look at it, I guess from a different view, let's look at a net asset value valuation of this business. So what's the current cost of the business as of time of recording? So the enterprise value, which is the market cap, plus net cash or net debt. So market cap plus the debt minus the cash on the balance sheet. You're looking at $943 million for this business, all said and done. So what do you get with that? Well, you get P2 reserves at around about, well, it's estimated 238 million barrels. If you exclude the Namibian assets. Why am I excluding the Namibian assets? Because we've recently seen some noise made in Namibia about them threatening to nationalize the uranium mines there, and who knows what's going to happen. If you add that back on, the valuation just gets ridiculous. So if we said P2 reserves, call it 238 million per barrel, what's the cost per barrel? So cost of the business divided by the amount of barrels that they have on their P2 reserves, and you're paying something like $3.96 per barrel. Obviously, you've got to spend money to get those things out of the ground, in this case, out of the sea. So what would that be? The company's estimating or reporting around about $30 of all-in sustaining cost per barrel. So when you look at that, if you happen to agree with that estimation as to what it's going to cost them to lift these barrels, there's a big margin of safety as to where Brent currently is. I mean, if you're looking in the $80 mark, even if you're making $50, call it per barrel gross, it's not bad. It's not a bad margin, guys. So at $90 Brent, let's call it, let's just say you're getting $54 of gross profit per barrel at $30,000 barrel a day over a 252-day working year. By that margin, what would that look like? Somewhere around 408 million EBITDA per annum. So that would make that look like a 2x EV to EBITDA multiple currently, and we expect to get a multiple re-rating as well as their ability to increase production. So there's another way, I suppose, at which I'm looking at the business. If we take that EBITDA, and it's a little bit harder to do it over a longer term because we're dealing with a cyclical business, but there are many reasons which I and several other guests have mentioned on this channel as to why we think this cycle may be higher for longer. And it's to do with the sustained depression of CapEx in the industry and so on and so forth, the inability of shale to simply come back online. Here are some assumptions as to an EV to EBITDA valuation. And you don't have to, this is just me writing numbers on a screen, right? So 408 million in EBITDA, I'm applying what is a reasonably conservative growth rate when you compare it to analysts' growth rates. Discount rate is the cost of capital. And we've got a bull, a bear, and a base case. Okay, and you can see the different assumptions that I've made for each. Each terminal multiple, I think, is reasonably conservative. Okay, and would you say that at the end of the day, if you put a probability weighting to these scenarios, it's suggesting a valuation of around about $21.40. If you wanted to get that at 2/3 margin of safety, you're looking at around $14. If we pull it apart and look at it from a different angle, if we take the free cash flow, so the base case for what I just did for the EBITDA, I do the same thing as to the estimated free cash flows on a per share basis, and I give them 0 credit for any potential buybacks. I invest today at $2.57. These are the cash flows expected to be produced by the company at the cost of capital, reinvested simply at the cost of capital. You're getting an IRR expected of around 33.61. So you're doubling your investment every 2 and a bit years using those maths. So, I mean, it's interesting to say the least. And this is why it's one of the reasons why it's one of my higher conviction plays moving into the sector. A few other little X factors I think here that might be worth noting is if you look at the ramp up in CapEx here, they've invested a lot in acquiring these assets, acquiring these leases, drilling rights, and so on and so forth. I don't think it's as simple as them having to reinvest at the same rate every year. I think it'll be more the case that they've front-end loaded a lot of their CapEx, and they'll have less capex that they need to sustain their business or grow their business moving into the future. In addition to which, if you look at their net debt, I mean, look, it's when you've got negative net debt to EBITDA, what are they going to do with all that cash? That's the question. Serviceability is not an issue. If they hit a rough patch or something happens, they've got the ability to service the debt. They can ride it out until things are looking better in the oil market, or they solve any jurisdictional or political issues that may arise given the geographical locations in which they operate. I think it's a de-risk business. I'm not saying it's zero risk. Obviously, there's always some risk. But if you look at the book value expected by the end of this year, we're getting it at a discount, and a significant discount at that, right at the time where they're expected to increase their production almost threefold. If that's combined with a very high oil price, I mean, then they're, yeah, I think that there are a lot of things lining up for this particular company. If you look at what they've done after they've obviously front-end loaded their capex, if you look what happens to their return on equity and their return on assets, their return on assets is increasing at a rapid rate. In addition to which, their return on equity is also doing that. And this is where I really want to draw your attention, is that the return on equity has improved at such a rate without them having to take on a lot of debt. Sometimes you look at return on equity and it looks really good, but the way they're getting those returns is just loading the company up with more leverage, more debt leverage. And that does not appear to be the case with this company at all. You've got expected increases in their production down here from 10 mil to call it 22 barrels is what the analysts guiding for the end of this year. We've just seen that management are actually saying it's going to be more like 33, 34. So again, with me doing those valuations that look very bullish, I've used the conservative estimates that are given to me by the analysts. Yet, I think the analysts are sandbagging a little bit in terms of what their barrel a day production will be. So there's a lot of room in terms of an upside surprise for this particular company. Now, if it's been one lesson for me personally this year, it's that management matters. I've seen a lot of very cheap businesses. I've invested, and I've been very disappointed with how management run the company. Castor Maritime, Nano Dimensions is starting to play out finally. Maybe I was a little harsh on Nano Dimensions, but they really needed a rocket to get their act together. Anyway, the point of all that is, when you look at who owns this business, who runs this business, are they the same people, and are their incentives aligned? I think it's very clear from the share registry here. The management team own 38 and 25% of this company in different holding companies. So my take on that is that the directors have every incentive to run this very, very well. They have a track record of doing so, and they are going to treat the owners or treat the shareholders like the owners of the business that they are, because that's these guys. They've got skin in the game. They're buying shares hand over fist, and I think that's really important when they are able to generate the cash that I believe that they will. And if the stock doesn't re-rate, what are they going to do? They're going to pay themselves dividends, or they may say, hey, we're trading at such a discount to net asset value, to book value, whatever. We're going to buy back. It doesn't make sense. We're going to buy back the shares and give the market confidence in the true potential of this business. Either way, as a shareholder, you get rewarded. And I think that that's far more likely to happen than them going to do some stupid acquisition or divest. If they do acquisitions, it's cash funded, so you don't have to worry about debt in a rising interest rate environment. And they have proven that they can take over assets, take over properties, and value add. So it appears so far, very competent management team. Interests are aligned with the company. The company's undervalued in a sector that's getting a huge tailwind, or I expect it to. So far, we've seen it play out with my other offshore investments. Capital is entering into the space because we need oil, and the offshore space seems to be where it's at in terms of it being such a low break-even cost of production now compared to where it was in the past, and with shale production being, let's just say, underwhelming in terms of its ability to ramp up production. So that's my thesis on the company. Go back somehow. I'm overweight the company. It's not available on eToro. I'm scaling into this, but no options market that I'm aware of, at least. I'm just buying straight equity, scaling in, and I'm actually looking to make a very large investment, minimum 6 figures over, over the next few months. I'll be scaling in, potentially, yeah, at least 6 figures. I don't need to go any further than that. My rationale is that it's trading at a big discount to its book value, so it's got a margin of safety. Its debt metrics aren't an issue, so the company should have liquidity, runway, and survivability to be able to realize the thesis. It's got the tripling of its oil production at the end of the year, might lead to a huge re-rating in the stock. Maybe not. Either way, shareholder returns program is in place with 20 to 50% of that net profit going back to shareholder returns once those two sites hit their full production. And given the competence of management, there's no reason for me to believe, at least at this stage, that won't be the case. So that's that. If you're interested in copying the portfolio, rolling 12 months, the portfolio is up 28.34%. I looked this morning, and I think we're up about 11% year to date. Finally, the thesis is starting to play out. If you like this content, please do like and subscribe to the channel, and I look forward to catching up with you in another episode shortly. Take care, guys.